Welcome to Market Brief After Hours. It has been an absolute roller coaster of a day on Wall Street. Just 24 hours after a massive Federal Reserve-induced sell-off, we've seen a stunning rebound. The tech sector led the charge, and some major players completely rewrote the narrative today. How would you summarize this dramatic turnaround?
It really was a classic relief rally. The market took a heavy beating on Wednesday when the Fed decided to hold interest rates steady, but today was all about buyers stepping back in, specifically targeting big tech and semiconductors. The Nasdaq Composite snapped a painful 6-day losing streak, surging 2.8% to close at 25,122. The Dow Jones Industrial Average clawed back some major ground, surging 614 points, or 1.2%, to finish at 52,208. And the S&P 500 climbed 1.7%, settling at 7,438.
Those are some massive gains, especially considering how grim things looked yesterday when the Dow dropped over 1,100 points. What changed in the span of just one day?
It came down to stellar corporate earnings and a return of the momentum trade. Microsoft was a massive catalyst today, with its shares jumping 16% after reporting blowout growth in its Azure cloud business. That single-handedly reignited optimism around artificial intelligence. We also saw semiconductors go on an absolute tear. The iShares Semiconductor ETF rose more than 8%, driven by Micron technology, which surged 18%, and advanced micro devices, up over 13%.
So the AI trade is back on.
Yes, but with a major caveat. It has become what analysts are calling a tale of two AI investment strategies. On one hand, you have Microsoft, which is spending heavily, but also showing massive profit growth. On the other hand, you have Meta Platforms, which fell 8% today after issuing a soft revenue forecast and reporting a staggering 91% drop in second quarter free cash flow. Investors are starting to distinguish between companies whose AI spending is already driving revenue and those where the high costs are eating directly into the bottom line.
That is a very important distinction for investors to make right now. Now, while equities were rallying, there was still some clear tension in the bond market, wasn't there?
Absolutely. Yields remained highly elevated. The 30-year Treasury bond yield hovered near its highest level since 2007, sitting above 5.2%. That's because investors are still deeply concerned that the Federal Reserve might be falling behind in its fight against inflation, especially after they voted 9-3 to keep the key interest rate steady at a range of 3.5 to 3.75%. Some economists, like those at Deutsche Bank, are actually still forecasting that the Fed will have to raise rates by 50 basis points later this year.
And we also got some fresh economic data today that painted a slightly confusing picture of the U.S. economy.
We did. U.S. GDP growth unexpectedly slowed down in the second quarter of 2026, coming in at 1.5%. That's a notable drop from the 2.1% growth we saw in the first quarter, and well below the 2.3% that economists had predicted. At the same time, inflation showed signs of cooling. The Personal Consumption Expenditures, or PCE price index, actually decreased 0.1% month-over-month in June. Annual headline PCE inflation eased to 3.7%, and the core PCE index, which excludes food and energy, edged down to 3.3%. So we have slowing growth alongside cooling inflation, which puts the Fed in a very delicate position.
It's a classic balancing act. Let's shift our focus across the Atlantic. How did European markets hold up today?
European markets closed broadly higher, even as they weighed escalating geopolitical tensions in the Middle East. The pan-European Stoxx 600 climbed 0.77%, with Germany's DAX up 0.6% and France's CAC 40 gaining 0.92%. However, the UK's FTSE 100 bucked the trend, edging down 0.1%. This came after the Bank of England decided to keep its interest rate unchanged at 3.75% in a split 6-3 vote.
And what about the broader Eurozone economy? We received some preliminary GDP estimates today.
The Eurozone actually posted its strongest quarterly expansion since early 2025, growing by 0.4% in the second quarter. That beat the market expectation of 0.2%. Spain led the way with 0.7% growth, and the Netherlands expanded by 0.4%. Even France, Germany, and Italy returned to modest growth of 0.2%. However, it's not all smooth sailing. Germany's annual inflation rate accelerated to 2.8% in July, driven by a spike in energy costs due to Middle East tensions.
Meanwhile, Italy's unemployment rate unexpectedly rose to 5.7% in June, which is its highest level since late 2025.
It seems Europe is dealing with its own set of mixed economic signals. Before we look at Asia and the currency markets, we're going to take a very quick break. Stay with us. Welcome back to Market Brief, After Hours. Let's head over to the Asian markets now, which had to digest the Fed's rate decision overnight. How did they react?
It was a highly volatile session in Asia. In Japan, the Nikkei 225 rose 0.71%, while the broader Topics index fell 0.54%. We saw some strong domestic consumer confidence data out of Japan, but there are growing concerns about the country's fiscal health after Prime Minister Sanae Takaichi proposed cutting the sales tax on food from 8% to just 1% for 2 years, starting in 2027. Over in China, the market struggled, with the Shanghai Composite down 0.62% and the Shenzhen Component dropping 2.73%.
And what about South Korea? I know tech sentiment has been incredibly swingy there lately.
Yes, the Kospi 100 fell 1.76%. What's wild is that Samsung Electronics reported a record second quarter operating profit, up a massive 1,814% year over year. Yet its stock still slipped 0.72%. On the flip side, South Korea's memory maker SK Hynix jumped more than 17%. It shows you just how sensitive these markets are to the ongoing tech and AI reshuffle. Meanwhile, down under, Australia's S&P ASX 200 fell 0.78%, despite a surprising 7.2% surge in dwelling approvals.
Let's transition to the foreign exchange market, where we saw some incredibly sharp moves today, particularly in major currency pairs breaking through key technical levels. What stood out to you?
The currency market was highly explosive today. Let's start with the euro-dollar pair. The euro-USD had a strong rebound, closing up 0.55% at 1.1530. Crucially, it breached its 50-day simple moving average at 1.1484. It's still trading below its 100-day average of 1.1567, but this move suggests short-term bullish momentum is building after a long period of lower highs.
And the British pound seemed to have an even stronger day.
Absolutely. The GBP USD surged 0.77% to close at 1.3470. This was an incredibly aggressive move that sliced right through its 50-day moving average of 1.3364, as well as its clustered 100- and 200-day moving averages, which were both sitting at 1.3398. This puts buyers firmly in control, with the psychological 1.3500 level now in sight. We also saw the Australian dollar perform well, with the AUD-USD clearing its 50-day average of 0.7011 to close at 0.7030.
But the real drama today had to be the Japanese yen. The liquidation there was intense.
Severe is the only word for it. The USD JPY plunged 2.49% to close at 159.33. It was an extreme bearish engulfing candle that completely shattered its 50-day moving average at 161.34 and its 100 at 160.05. It finally stalled just above its 200-day moving average at 157.88. This massive liquidation has completely disrupted the long-term bullish channel for the dollar-yen.
Unbelievable volatility. Let's touch on commodities quickly before we get to our individual market movers. Gold and silver seem to be trying to find their footing.
They are. Gold edged up 1.08% to close at $4,110. It's still well below its key moving averages, like the 50-day at $4,208, but we are starting to see a solid basing phase above the $4,000 mark. Silver had an even stronger day, surging 2.78% to close at $59.20, attempting to break out of its recent consolidation range. Meanwhile, oil prices actually fell. Brent crude dropped nearly 2% to $89.03 a barrel, and WTI fell about 1% to $83.59. This happened after Saudi Arabia proposed a 40-country naval coalition to protect key shipping routes in the Red Sea and the Strait of Hormuz from Iranian attacks.
That's a significant geopolitical development that could help ease some of those global shipping and inflation fears. Now, let's wrap up with today's key market movers. We had some massive after-hours earnings reports that are going to set the tone for tomorrow. Who were the big winners and losers?
Let's start with Amazon. They reported better-than-expected revenue and cloud growth, with AWS sales expanding 37% year over year. That beat analyst expectations of 31%, sending the stock up more than 9% in extended trading. On the other side, Apple reported strong overall earnings driven by a 22% increase in iPhone sales, but the stock slid 4% after hours because their services revenue missed estimates.
And what about Reddit?
Reddit actually beat expectations on both the top and bottom lines and issued strong guidance, but the stock still slid over 8% in extended trading. In the crypto space, we saw a massive rally during regular hours, with Riot platforms up over 20% and Mara Holdings up 17% as Bitcoin rose. However, Coinbase dropped 5% after hours after posting a wider-than-expected loss, showing that the crypto winter is still biting. Finally, we had some heavy losses in other sectors. Fair Isaac fell over 17% on weak revenue guidance, Norwegian Cruise Line dropped more than 9% after cutting its annual forecast due to weak bookings, and Crocs fell over 8% on weaker-than-expected earnings guidance.
It is clear that the market is rewarding actual performance and punishing any sign of weakness or high spending without immediate return. This has been an incredibly detailed breakdown of a very busy day. That is all for today's episode of Market Brief After Hours. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform.